What if I told you that price doesn't just randomly zigzag up and down? What if it actually respects invisible lines on a chart? Crazy, right? Well, today we're diving into what is arguably the most powerful concept in all of technical analysis: support and resistance. Whether you trade stocks, forex, or crypto, this is absolutely the ultimate foundational tool. Seriously, once you grasp this, you are never going to look at a price chart the same way again. Welcome to this explainer on mastering market floors and ceilings. I am super pumped to walk you through this today because mastering these levels, finding those clusters, spotting the zones, and running precise bounce and breakout strategies, it's a total game changer. This isn't just some textbook theory. It is literally the bedrock of market structure. All right, here's our roadmap for this explainer. Part 1, the invisible market lines. Part 2, spotting the zones. Part 3, the execution playbook. And finally, Part 4, common traps to avoid. So let's jump right into Section 1, the invisible market lines, and cover the core concepts. Picture this. You've got support on one side and resistance on the other. Support is basically a price level where buying pressure is just so strong that it stops the price from falling any further. Think of it like a literal floor. The price drops, hits this level, and just bounces right back up. Resistance, that's the exact opposite. It acts as a ceiling. As the price climbs and hits this zone, selling pressure takes over, pushing the price back down. So it's this constant, ongoing battle between the buyers at the floor and the sellers at the ceiling. Now, you might be wondering, why did these invisible lines even exist? Well, it all comes down to human psychology. You see, traders have memories. They remember exactly where a price reversed in the past, and because of that memory, they tend to place their buy orders right near that support floor and their sell orders up near that resistance ceiling. So when you get thousands of traders clustering their orders at these exact same historical levels, it essentially creates a self-fulfilling prophecy right there on the chart. But here's the catch. You have to know how to validate these levels. A price might bounce once and you think, hey, there's a floor. But true validation, that comes with repetition. When price touches a level multiple times, like say 3 distinct bounces, and just refuses to break through, that absolutely confirms the massive strength of that specific floor or ceiling. Every single time the price tests that line and holds, the market is basically screaming at you that this is a highly significant zone. Okay, moving on to Section 2, spotting the zones, where we'll look at exactly how to find these floors and ceilings. So we've got a rigid 4-step process for pinpointing these levels on your screen. Step 1, zoom out. You always want to start on a higher time frame, like a weekly or daily chart. The more visible a level is from far away, the more significant it is. Step 2, look for price clusters. You're hunting for areas where the price reversed, consolidated, or honestly just spent a lot of time hanging out. Step 3, and this one is absolutely vital, mark zones, not exact lines. Give your levels a buffer of 5 to 10 pips, or a small percentage depending on the asset you're trading. Price action is messy, guys. Treat it as an area, not some razor-thin wire. And step 4, like we just talked about, count the touches. The more tests a level survives, the stronger it gets. Oh, and here is a massive pro tip you can start using right away. Keep an eye on big round numbers, like $50,000. Numbers like 100, 1,000, or 50,000 naturally act as incredibly heavy psychological support or resistance targets. Human brains just love clean whole numbers, so traders naturally place their orders exactly at these milestones. Definitely keep a close eye on them when you're drawing out your zones. All right, let's get practical with Section 3, the execution playbook, bounce and breakout. First up, we have the bounce trade. The logic here is super simple but incredibly effective. You buy at support or you sell at resistance, fully expecting the price to reverse. So first you wait patiently for the price to approach your strong zone. Next, you look for a confirmation candle. Once you've got that confirmation, you enter the trade. Now, crucially, you place your stop loss just outside the zone, so below support or above resistance, just in case the level fails and you need protection. Finally, you target the next key level for your take profit. Done right, this usually yields a fantastic risk-to-reward ratio of 1 to 2, or honestly even better. I want to hit pause on that confirmation candle step for a second, because it's a make-or-break detail. You should never, and I mean never, just blindly enter a trade the second price touches your zone. You need the market to prove it's actually rejecting that level. Look for specific candlestick patterns, maybe a pin bar with a long wick, an engulfing candle that totally overtakes the previous one, or a doji, which shows deep market indecision. These visualize a sudden shift in momentum and give you concrete proof that the buyers or sellers at that zone are actually stepping up. But what happens when the floor literally falls out? Well, that brings us to our second strategy, the breakout trade. Sometimes price doesn't bounce at all. It just smashes right through the level. Here is how you play it. First, watch for a strong candle that closes clearly beyond your zone. Now hold on, don't jump in just yet. Wait for a retest of that broken level. This is a brilliant little concept called role reversal, where an old ceiling becomes your new floor or vice versa. You enter on that retest. Your stop loss goes on the other side of the newly broken level, and you target the next key zone. When these breakout trades hit, especially with high volume, the moves can be absolutely explosive. Now for some critical risk management in Section 4, guardrails, common traps to avoid. Let's rapid fire through the 4 cardinal sins of trading support and resistance. Trap number 1, trading every single level. Look, not all zones are equal. Prioritize quality over quantity and only trade the strongest, most tested levels. Trap number 2, ignoring the overall trend. Buying at support while the market is in a massive downtrend? Yeah, that's just fighting gravity. Always trade with the bigger trend. Trap number 3, no confirmation. Patience is literally your biggest edge here, so wait for those signals we talked about. And finally, trap number 4, moving your stop loss. If the price hits your stop, it hit your stop. Do not drag it further away, hoping things will magically turn around. Protect your capital at all costs.
Let's wrap things up in Section 5, Summary and Action Steps.
Just to bring it all together, remember this core mechanic. Support is your floor, where price bounces up, and resistance is your ceiling, where price bounces down. You find these by zooming out, marking your zones, and counting the touches. When it comes to execution, you either trade the bounce by waiting for confirmation candles, or you trade the breakout by waiting for that role reversal retest. And through it all, you always use a stop loss and respect the broader market trend. Support and resistance really is the absolute foundation of technical analysis. Once you master spotting these floors and ceilings, every single other trading strategy you learn is going to make so much more sense. It's like it brings total clarity to a chaotic chart. So my question to leave you with today is this. Now that you hold the keys to mapping out these invisible market lines, which market will you apply it to first? Take a look at your favorite chart today, zoom out, and start drawing your zones. Keep learning, keep analyzing, and I'll catch you in the next explainer.